Okay, let's start with stock dividends. Let's say that our mini corporation's board wants to declare dividend but doesn't have the cash for a cash dividend. Now, we'll talk about the motivations for stock dividends and stock splits a bit more in class. But anyway, let's just assume that they decide to declare a stock dividend, and so they vote to distribute additional shares of stock to shareholders. A stock dividend is defined in terms of a percentage of presently outstanding shares, and the amount of the dividend is deemed to be the market value of the shares being issued. It's kind of interesting. In class, when I use these terms very often, like market value of the shares, I'll use, do the little rabbit ears with my fingers to indicate this is kind of it's an interesting concept here. I'll explain more in just a moment, but let me say here that notice once again, cash dividends are declared. What they are declared, they are payable only on shares that are outstanding. And same thing goes for stock dividends here. They are declared and distributed, not paid, but distributed only on the basis of shares that are outstanding. Well, let's look at the entries here. On June the 2nd, 2018, Armenia's board of directors declares a 10% stock dividend at a time when the market price is $18 per share. Shares are to be distributed on July 15 to stockholders of record on 6/15. Kind of reverse these just to keep you hopping a little bit. In other words, date of declaration, June the 2nd. Date of record, June the 15th. Date of distribution, July 15. These dates, the actual dates between the declaration, record, and so on, can be 2 weeks up to a month. But, for the most part, it makes, it's going to be in that range there, 2 weeks to maybe a month gap between each of those dates. Now, here's some important calculations to recognize. We're going to calculate what's called, in quotes here, the market value of the stock dividend, and that's $360,000. Where does that come from? Well, notice the shares outstanding are 200,000. The stock dividend, as a percentage of those shares, 10%. 10% of 200,000 gives us 20,000 new shares that are being issued, and those shares are worth $18 each. So 20,000 shares times $18 is $360,000. That's deemed to be the value, the market value of that stock dividend. And then the stated value, keep in mind this in the information provided at the beginning of this example, we noted that the stock had a stated value of $5 per share. That's really the same thing as a par value. It's just a different way of expressing it. So 200,000 shares, 10%, 20,000 shares times $5, and that's the amount, as you'll see, that we're going to credit to the common stock account. Well, here we go. There's the entry on the date of declaration. Debit retained earnings for the total amount, the dollar amount, the value of this dividend. Credit an account called Common Stock Dividends Distributable for the stated value. I almost said par value. The stated value of $5 per share, and then credit paid in capital excess of stated value for the difference. Once again, that PIC is a plug figure, but once again, notice also the stated value, not par value. Next is the date of record, and once again, there is no entry, although that same process occurs to determine who owns the stock for purposes of this stock dividend. So even though there is not a payment of dividends, there still is an ex-dividend date. And if you buy the shares, for instance, before that date, and you hold them throughout, then you get until the next day. Then you get that stock dividend. But if you sell those shares before the ex-dividend date, or you buy them on the ex-dividend date or after, then of course you don't get that dividend. On the date of distribution, then the entry is debit to common stock dividends distributable and credit to common stock. So it looks very similar, as you can tell. The stock dividend entry is very similar to the cash dividend entries. Well, one of the key differences, as you can see, is this use of an account There it is. For common stock dividends distributable when we recorded the dividend on the declaration date, and then on the date of distribution where we debited that account. Now notice, by the way, the nature. Let's think for just a moment about the nature of this account. If on the account we used earlier, common stock dividends payable, well, you know that payable screams liability by now, I hope, right? So you know it's a liability. It is a real account, has a normal credit balance, and appears on the balance sheet. Well, here with the common stock dividends distributable, you're really not paying anything. You're distributing more pieces of paper. And so the company is not giving up anything of value in truth. As a matter of fact, as we'll see later on, this common stock dividend involves transferring money from retained earnings to common stock and paid-in capital accounts. So it's really a transfer within stockholders' equity. And so it's not quite the same thing as a cash dividend, of course, where you're actually sacrificing assets of the company. So what do you think common stock dividends distributable is? Well, in this case, look at what it becomes, and that is common stock. Common stock dividends distributable is a common equity account, a shareholder's equity account. And so it has all the features of common stock. It's a real account with a normal credit balance and appears on the balance sheet. But it represents equity. Okay, the above that this example was one of what's called a small stock dividend. Small refers to a stock dividend less than 20 to 25% of shares outstanding. You're probably wondering, well, is it 20 or is it 25%? Actually, it's exactly the way it's written. That is in the pronouncements, 20 to 25%. You'd like for them to draw a line, but the reason they're less specific about it is because really what they're trying to figure out is this. Because of the highly, let's say, dilutive effects of a large stock dividend, the potential for that, then it could be a real, let's say, cause a real problem in shifting money from retained earnings into paid-in capital when you are declaring and distributing a large dividend. And so, in fact, what we're going to do is not determine the value of the dividend based on market value, but only on par value. Maybe something we have to wait for class to talk about a little bit, but the distinction, the decision as to whether you might have a dividend that represents a 20% stock dividend that could be considered large if the impact on the firm's equity is and on its market price as a result of these shares being issued is substantial. And you could have a stock dividend that's say 24-25% up the upper end of the range that would be considered to be small, and therefore accounted for as a small stock dividend if in fact its impact on the market value of the stock and is in fact minimal. Well, let's just again look at the rule here. A small stock dividend refers to one that represents less than, involves 20 to 25%, less than 20 to 25% of shares outstanding. A large stock dividend occurs when the dividend is greater than 20 to 25% of shares outstanding. So let's go back and look at the example we just dealt with. Let's say there's a large stock dividend involving an issuance of 40% of shares outstanding. There are 200,000 shares outstanding, so that's 80,000 shares. The large stock dividend is valued, see the quotes there, using only the stated value of $5 per share. So the amount of the dividend, $400,000, 200,000 times 40% means we're issuing 80,000 shares at $5 a pop. That's 400,000. So is the amount of the dividend. And here's the entry. We simply debit retained earnings and credit common stock dividends distributable for the full amount. There's no allocation of that between common stock and the and paid-in capital in excess of par here. And on the date of record, once again, no entry. And date of distribution, we really just, well, you see it right there. Debit common stock dividends distributable, credit common stock. So you see hopefully the parallelism there. That's about as far as we'll go right now.